Sarah Morgenthau, President and CEO of I Have a Dream Foundation, and you're watching Taking Stock.
Let's do it, one and all. Welcome to the broadcast. 2 minutes to go or so until the close for this, the first trading day of a shortened holiday week after the President's Day holiday. And of course, this week, also kicking off the fresh Lunar New Year, and Ramadan as well. As we head into the closing auction, not entirely clear where the major market indexes will actually finish the day. They've been kind of seesawing back and forth since this morning's tape, from negative territory to positive territory. But at least at this hour, the S&P 500 and the Dow both holding on to fractional gains. Investors waiting, no shortage of important data points set to cross the wire here on Wall Street between now and the end of the trading week. That, of course, includes the January Fed minutes. We get the PCE inflation print on Friday of this week. And how about earnings? Earnings Palooza continues to roll along. 57 companies in the S&P 500 set to report their quarterly results in the next few days. That includes S&P favorites like Walmart, Carvana, DoorDash, among many others. Your strongest performing sectors in the S&P 500 on this trading Tuesday include financials, industrials, and real estate, though we do see laggards including staples, energy, as well as materials. Welcome to the show. You're watching Taking Stock. I'm your host today, J.D. Durkin. Almost time here for the closing bell here at the New York Stock Exchange. The man himself, the great Phil Rosen's on deck. He'll join us right after the bell for his take on today's price action and what to look for as we get these crucial quarterly results. Time now for the bell. We'll pick up the broadcast after this. You gotta love when a closing bell guest hits that gavel with authority. That's what it's all about. All right, it does appear as if the major market indexes will hold on to fractional, and I do truly mean fractional gains across the big board here at the NYSE. The S&P 500 up 0.1%. The Dow up 0.07%, eking out gains. The New York Stock Exchange Composite Index finally taking a breather after what has felt like weeks of all-time highs, and the small caps just about flat on the day as well. Gold and silver both down for the trading session. All of the crypto majors under at least a little bit of pressure here to start the week. Your best performing Dow names on this trading Tuesday include Apple, American Express, Visa, and Nike. Your Dow laggards on this Tuesday, Walmart, Home Depot, and Salesforce, which continues to be the worst performing Dow name here in 2026. Let's bring in the man himself, Phil Rosen, co-founder of Opening Bell Daily and host of Full Signal. My man, thanks for being here.
Thank you for having me, JD.
Man, where do you want to start? I mean, we've got a lot of stuff going on, so you take your head up, not at all-time highs, but not very far off, but it sometimes doesn't feel it, given how volatile and choppy a lot of these sessions have been recently, Phil.
Well, so far, everyone is talking about the tech sell-off. The Mag 7 are down about 7% to start the year, and the S&P 500 is about flat. But to me, this is a story of rotation. I don't see it so much as bearish on tech. I see it as very bullish for the entire market. I think this is a broadening. This is very healthy for a bull market. You have the equal weight S&P 500, which is actually up to start the year, higher than the market cap weighted index. And then you also have the Mag 7, which is down, but then the S&P 493 is up, I think, about 5%. So this is a continuing story of broadening. And if you're bearish on tech, I don't expect it to stay down for the whole year, but I think this healthy rotation is very, very good.
I mean, it's amazing to look at the Mag 7. We made so much at the end of 2025 about what the outperformers were, but also the underperformers. A name like Amazon that relative to the rest of the Mag 7 had been underwater last calendar year, and yet here we are. Look at the equal weights doing so much better here, or we say the 493 versus the Mag 7. Is that your expectation to continue?
So this morning in my newsletter, I called it the Magnificent 493. This will probably continue. Earnings look very good for 493, and they're just about equal with the Mag 7, which hasn't happened in about 3 years. I think S&P 500 earnings strength is as strong as it's been in 3 years. So all this momentum, I don't see how this slips up, especially because this broad market strength has been continuing, even though these AI fears have taken out financials, software, trucking, logistics. Everything is getting hit by AI fears, and yet the entire market is still fairly healthy.
Software, commercial real estate, trucking, financial services, you name it. We're in this very skittish environment where a private AI company announces a really cool, splashy, new, very neat AI tool, and then we have this perception that we're going to basically indiscriminately sell all these stocks that may or may not be impacted, but perception drives the reality. Are you surprised that we've kind of had this rolling impact now stretching over not just a couple of days, it's been the better part of the last few weeks?
There's a very typical habit on Wall Street to sell first, ask questions later.
Yeah.
That's exactly what we're seeing all year, right? Software got hit the most. It's still getting hit. You saw the financial services sector, that sold off very, I'd say knee-jerk reaction. We're probably going to see this rolling knee-jerk over the next coming weeks, maybe for the next few months, because there's no way that AI stops getting better this quickly. It's only going to get better, right? So all these sectors, investors are trying to figure out the winners and losers in real time, and within those sectors, the winning and losing plays, right, the individual stocks. And it's very hard to decipher in real time because we don't know what stocks will get more profitable or have their moats disappear because of AI, but the market's trying to price it all in real time.
Yeah, absolutely. It reminded me of the knee-jerk reaction that we had from the DeepSeek-fueled sell-off now just over a year ago, but this is kind of DeepSeek with teeth because it's not just a one-day thing with a bounce back. We're kind of seeing it roll from sector to sector. Before I let you go, talk to me last week, Bitcoin Investor Week. Talk to me about some of your top takeaways and how is the overall mood given we are so far off those October highs of 125, 126?
Yeah, we're almost there to the 50% drawdown mark.
Wow.
But for Bitcoin, this has happened every couple years for a decade. So the mood at the conference was actually very optimistic. No one's talking about a bear market. Everyone is saying, okay, how much longer are we going to hold until this thing comes back? And all the people I spoke with remained very optimistic. No one was talking about rotating out of Bitcoin, finding other cryptocurrencies, getting into big tech. There was none of that chatter, and really it was mostly about AI being a secular tailwind for Bitcoin over time. So we're in the early days of AI still, and if Bitcoin is down 50%, once AI picks up, maybe, according to some of the folks at the conference, Bitcoin will pick up as well.
I'd imagine if you're an attendee at something called Bitcoin Investor Week, you're probably a holder of the asset class despite some chop and volatility.
I am a holder, and pretty much everyone I talked to at the conference was a holder. I did not meet a single bear at the conference, so maybe there's a red flag for you to take home. But other than that, it was a great time.
Please come back anytime. The great Phil Rosen, co-founder of Opening Bell Daily. Please watch all of this man's interviews up on his brand new show, Full Signal. It is can't miss television. My man, thank you for being here as always.
Thank you, JD.
Josh will grab your mic. Howie, you and I head this way. We'll bring our viewers the latest analyst calls here to kick off this shortened holiday trading week. We'll start with Citi. Analysts at Citi reiterating NVIDIA as a buy. They say the valuation actually looks pretty attractive with the stock likely to outperform in the second half of 2026. It is so far the best performing Magnificent Seven name here year to date. Shares only down 3%. That's not a lot compared to some of the other names here. Next up, JP reiterating Carvana as overweight. They are saying AI fears are overblown, despite the fact that Carvana shares are down more than 15% here to start the year. Citi also initiating BitGo as a buy. Remember, BitGo IPO'd right here at the New York Stock Exchange about 4 weeks ago. And finally, Wedbush Securities reiterating Apple as outperformed. They are citing the release of new AI features later this summer as a tailwind on AAPL. Shares of Apple are down about 4% here to start 2026. How about a look at a couple NYSE notables? We'll continue the train with analyst calls on LUV, that is Southwest, getting an upgrade from UBS analysts to buy from neutral, and in doing so, boosting the price target from 51 to 73. It's right around 54 and change today. Has been in a very strong uptrend, up 80% since early November. The last time it traded at these levels, you got to go all the way back to October of 2021. And how about this name here at the New York Stock Exchange, the best performer of the S&P 500 today, Norwegian Cruise Line, shares up more than 12%. They are contending with a bit of a leadership shakeup. Brand new CEO John Chidsey taking the reins not long ago. Shares are up 5% on the year, but still off their pre-pandemic 2019 levels by about 60%. Norwegian Cruise Line set to report quarterly results next Monday, March 2nd. The New York Stock Exchange's very own Ashley Mastronardi sat down with Chara Petrioli of WSense to discuss all of the ways that her firm is, quote, giving voice to the ocean. Take a look.
Endeavor bills itself as a global network for high-impact entrepreneurs. It selects, supports, and invests in category-defining companies that are impacting economies around the world. One of these Endeavor companies is Europe's WSense. They said they invented underwater ocean Wi-Fi. Joining me now to share more is Chara Petrioli, WSense's CEO. Thank you for joining us, Chara.
Thank you for asking me.
What is WSense?
WSense is a deep tech company, so based on international patents, solving underwater connectivity. We are able to exchange data among whatever we have underwater, distributed sensors, drones, exploring and operating for us in an environment where we are not present, the underwater environment. 70% of our planet, which we know much less that faraway planets such as Mars, because we cannot use everything that is at the core of our economy. We cannot exchange data to traditional Wi-Fi. We cannot use remote sensing. We see through satellite only a few meters below the surface. So we really had to find a way to digitalize the blue economy to allow to get data and then be able to build intelligence and services in this environment. This is what we do in WSense, make this available to the world.
What are the use cases? I know you mentioned drones, but what are the use cases for underwater ocean connectivity? What can you do with it?
Think about the traditional way we exchange bits above water, not through internet. And now it's key because this, together with computational capability and AI, is changing our world. But when we transmit bits through the internet, 90% of this go through underwater telecom cable. So these are now prone to being attacked. There are threats to this. And basically, we don't have anything like video surveillance systems underwater to identify if there is a problem, potential risks for the underwater telecom cables or underwater infrastructures. So for instance, we have developed resident monitoring system and underwater Internet of Things, where we reason on the data, we transmit real-time information such as threats, implementing this monitoring and protection of underwater critical infrastructure. We also are digitalizing, and we're part of the standardization body for this, in the energy field, for instance, in oil and gas fields, a network of drones are going to operate for us the plants underwater. And this is just an example. We also, with our underwater IoT, we are doing structural monitoring during construction in maritime environment. We are doing metocean monitoring, providing in real time unprecedented information from the ocean. We say that we give voice to the ocean.
What support has Endeavor provided you in your entrepreneurship?
Well, it's an amazing community. First of all, because as an entrepreneur, you're paving a new way in a company like WSense. You are making things that were not possible before. So you really don't know, right, how to scale fast and how to contribute, finding the right way in a novel market. So Endeavor is an amazing community that has the highest density of unicorn founders. So it's a community of trust. So we talk to each other, we speak to each other, we open doors. You can actually have mentorship from all the others and sharing of experiences. That is an invaluable opportunity for entrepreneurs, I think, to fast act, which is a key aspect to fast grow in a hyper growth company. And then you get access to talents for growing, which is very important. You get access to the best investors. So this is what I'm getting from this experience. I'm also starting giving back. So also to the other entrepreneurs, sharing also my experience to avoid some, wheel blocking, because in Endeavor, we really are trying to shape the future of the world. So we really want to have a super strong impact through novel, innovative entrepreneurship.
All right. Thank you so much, Chiara, for joining us at the New York Stock Exchange.
Thanks.
In the middle of the show, coming up. Welcome back to the show. You're watching Taking Stock live from the trading floor of the New York Stock Exchange. Time for a few headlines in the worlds of fintech, crypto, and artificial intelligence to kick off your Tuesday afternoon. First up, the crypto majors are flat, but honestly, all things considered, not by much. ETH is down fractionally at this hour. Bitcoin trading down 1.7. Solana down a clean 1%. Next up, and this is a big one, at least over on social media today, CFTC Chair Michael Selig pushing back on what he calls overzealous state regulators, going as far as to file a friend of the court brief in support of Crypto.com. He argued prediction markets fall under federal derivative law, not state gaming rules. I have a sneaking suspicion this debate is not going anywhere anytime soon. Finally, the Wall Street Journal first to report companies like FTAI Aviation are converting retired Boeing jet engines into natural gas turbines. It's a move that could unlock gigawatts of new capacity as AI data centers scramble for electricity. All right, time to say hello to a good friend of ours here on the show and our next guest. This is Bill Mann, Chief Investment Strategist at Motley Fool Asset Management. Feel like I haven't seen you in a long time. Thanks for being on the show.
Happy New Year to you, the year of the horse.
There you go. Absolutely. As we mentioned at the top of the broadcast, Lunar New Year, Ramadan, lots of things going on this week after the President's Day holiday. More broadly, before we kind of get into the nooks and crannies of the market, you take a look up. This is a market trying to find its identity. Low volume across the tape, at least today. It's a short and holiday week. Yeah. What do you make of basically the all-time highs? We're not very far away from here, Bill.
Not far away from it, but the market internals have been, have been quite volatile. You've lost about $1 trillion in market cap in the software sector alone, and so there is a lot of people are really trying to find what AI means for a lot of different industries, and it's been, it's been really tough to find your footing, and so it's so interesting that the market is actually still close to all-time highs.
Yeah, and the thing is, we come into another day, we just don't know what the next big sector of stocks will be, where the thesis is AI is set to rattle those particular companies, right? It was commercial real estate, it was financials, and that may very well continue for some time. I know you cover global markets a lot. Do you see the United States at all losing appeal, at least relative to what's going on right now in international play?
So we are now at a point in time. The U.S. at one point last year was about 62% of the world's market capitalization. It's now in the mid-50s, which suggests that people have become more interested in foreign markets. We find a lot of value in places like Japan now, and I think that a lot of it has to do with the fact that we've seen a fair amount of valuation fatigue in the U.S. It is the most highly priced developed market in the world, and I think people are looking for a little bit of exposure elsewhere.
Is it that the valuations here in the U.S. can be running a little bit too hot? Is it that things are going exceptionally well in some of those markets like Japan, or a bit of both?
A little bit of both. I mean, since 2020, we've generated $29 trillion of gains in the U.S. market alone, which is a pretty big number. So, things have gone very, very well in the United States.
Yeah, of course. 1 trillion is a million. I know after a while these numbers kind of blend together in our brains. 29 trillion is, simply put, it's a ton of money. Let's talk about a few stocks. You and I were talking about these earlier. What do you like and what are you seeing out of Nintendo right now, speaking of global reach?
So Nintendo, Japanese company, absolutely fascinating company. They really have had all of their competitors decide to get out of the platform business, and so they have really taken over. It is one of the few companies that gets paid to advertise. If you think about their character library, fascinating company.
Yeah, absolutely. Lots of people love the treasure hunt. You and I talked about this earlier. How about TJX? As we talk so much about the U.S. consumer increasingly value shopping, what do you see there?
Yeah, so TJX, one of the companies that's component in our TMFC ETF, and it's a company that is resistant to both tariffs and to spending tendencies across the board. People love the treasure hunt regardless of what part of the market that they are in, yeah. And so we think that is a company that is well suited for the future.
Our good friend Bill Mann, Chief Investment Strategist at Motley Fool Asset Management. Come back anytime. You have an open invite. It's nice to have you.
Thank you so much. Happy New Year.
You as well. Don't go anywhere. Much more Taking Stock coming up after this quick break. Welcome back to the show. You're watching Taking Stock live from the trading floor of the New York Stock Exchange. Time now to give you the latest headlines in the world of startups, raises, and rounds for your Tuesday afternoon. First up, Elon Musk, SpaceX, and XAI. They're now competing in a secretive $100 million Pentagon challenge to develop voice-controlled autonomous drone swarm technology. It's a mouthful. It's also very important. It's a major step into AI-powered defense systems that could have offensive applications. Next up, PNB Paribas saying Anthropic saw daily active users jump more than 10% after that Super Bowl ad took aim at OpenAI's move towards ads, and in doing so, outpacing ChatGPT and Google Gemini. And finally, Joshua Kushner's Thrive Capital closing a $10 billion round, twice the size of its last raise, as the firm doubles down on high-conviction bets and what it calls a ride-or-die approach to the ongoing AI boom. John Kim joins the broadcast now down here on the trading floor. He is the co-founder and CEO of Reckoner Capital Management. Great to have you here on the show and joining us here at the New York Stock Exchange.
Thanks for having me, Judy.
Give us, first and foremost, a bit of an introduction to your work at Reckoner for anyone a bit unfamiliar. And also, John, what would you say are some of the firm's top priorities here in Q1 of 26?
Yeah, so we're an alternative credit manager. We specialize in structured credit and other areas that are being brought now to the retail markets across the country. We launched 4 funds last week on the New York Stock Exchange. They're all ETFs based on CLO bond portfolios. So we have a flavor that is more safe, AAA rated. We have a flavor that's a little bit more high yield, BBB rated. And then we have some interesting dividend frequency funds that sit on top of that. And that's where the interest lies, I think, from a lot of retail investors and also advisors, because some of them you will be able to sort of determine what frequency you want to receive your dividends in. Most of the competitor funds are monthly pay, so they're going to be income taxable. If you don't get a dividend, or you can at least control when you receive that dividend or take advantage of your gains, you can potentially get better tax treatment for those funds.
John, how do you go about determining the type of ETF product to issue? Is it contingent on macroeconomic conditions? Is it general market conditions? Is it feedback from would-be retail investors, or a little bit of all those things?
It's a little bit of all those things, but it's mostly the third one, because we are trying to listen to our investors and bring them funds that actually make a difference in their portfolios. We do not want to issue the 18th, XYZ fund in a certain area. We'd like to bring some innovation and solve some issues for the ultimate investors in our funds, and that's what we feel these new funds do, from a taxation perspective.
Of course. What do you think had been most among the biggest pain points that those retail investors had that you feel like you could uniquely address in the market by providing them ETF products that maybe they could not quite get anywhere else?
So there's 2 things with our funds. The first one is we're bringing a product that historically was only institutional. And bringing that to the retail markets really allows people access to risk-adjusted yield that they were not able to get before. The second thing that we're bringing is, people asked us, is there any way that I can not get a 1099 on these monthly dividends? And we're trying to address that by saying, no, now you can choose your dividend frequency, and you can reinvest all of your dividends if you want to. Just keep it in the fund, buy the stock, it'll accrete up in NAV, and you can sell it when you want.
What would you view as being among the next frontiers for Reckoner in the general alternative credit space? I'm sure you're all working on a lot of exciting things here for 2026, in addition to the suite of ETF products you've already rolled out.
We have a lot of plans, a lot of ideas. The first thing we're going to do is concentrate on our knitting, our core, which is structured credit. And we're going to continue to make more structured credit asset classes available to the general public in a very easily consumable wrapper. So everything is about ease, access, making sure that people are getting good risk-adjusted yield for what they're bringing to the table, and we want to continue to do that.
What does it tell you overall that we're seeing such strong demand for ETF? There are actually more ETF-listed products than there are underlying publicly traded companies today.
It is definitely the future. People want to choose a specific kind of exposure that they're getting to the market. ETFs are clearly a very, very good way to do that. And I just think that's going to continue to grow. I mean, as more people come up with more ideas, people will find better ways to invest ultimately in their fund.
John Kim, co-founder, CEO, Reckoner Capital Management. Thanks for joining us here at the Big Board and for being on the broadcast. It's great to have you.
Thanks, Judy.
Don't go anywhere. Much more Taking Stock, including the latest from Scarlett Sieber at Money 2020 after this.
Welcome back. I'm Scarlett Sieber from Money 2020, and this is Jargon Translator, where we decode the finance slang that sounds like agriculture, but it is all about crypto gains. Today's term, yield farming. Yield farming is basically earning interest on your crypto by lending or staking it in DeFi platforms. You lock up your tokens, and in return, you get rewards, usually in more tokens. Think of it like putting your money in a high-yield savings account, except instead of at a bank, it's a smart contract running on the blockchain. Why do people love this? Because the returns can be wild, sometimes way higher than traditional banks. We're talking double-digit APYs that make your 0.01% savings account look like a joke. And for a while, during the DeFi boom, people were stacking tokens like they were stacking sneakers, and I love my sneakers. But here's the catch. It is risky, like really risky. Smart contract bugs can drain your funds overnight. Platforms can get hacked, and token prices, they swing harder than a TikTok trend cycle. You might earn 100% APY in tokens, but if that token crashed by 90%, your farm just turned into a desert. And then there's the impermanent loss, a fancy way of saying you can lose money even while providing liquidity. It's like planting seeds and watching the soil disappear. This is brutal. Yield farming exploded during the DeFi summer of 2020 when everyone was chasing insane returns. Today it's still around, but the hype has cooled as regulators start paying attention and investors realize free money usually comes with the fine print. Next time you hear yield farming, don't picture tractors, picture crypto hustlers chasing APYs like their trending TikTok sounds. Yield farming, when your money works the fields, but sometimes the harvest is just weeds. And that is your jargon translated.
Tomorrow morning, we will get the long-awaited January FOMC minutes from the Fed. We'll also get the latest on housing starts and durable goods. Tomorrow morning's earnings include Garmin and Fiverr. And tomorrow after the close, Carvana, DoorDash, Figma, and eBay. That's it for today's edition of Taking Stock. See you tomorrow. Woo!